The Basel Accords, how invisible rules control global finance. 1. The problem with quiet power. No one voted for Basel. There were no protests, no campaigns, no headlines. Just a few central bankers in a quiet Swiss city deciding how much risk the world was allowed to take. So what does that actually mean? It means that global finance has a referee no one ever elected. Back in 1974, a small German bank called Herstatt blew up mid-transaction. Halfway through a currency trade, the money vanished between time zones. That small failure froze the entire system. Globalization had arrived, but the rules were still local. Central bankers realized the game was global, and no one was really in charge. So they met in Basel and formed a committee. Not to rule the world, they said, just to coordinate it. Yet coordination quietly turned into control. The group became the Basel Committee on Banking Supervision, a kind of invisible government for money. Footnote. The Basel Committee emerged from a single banking failure and evolved into the world's de facto regulator of global finance. 2. Basel I, the first global rulebook. By 1988, the committee launched its first grand experiment, Basel I. It sounded simple: every bank must hold at least 8% of its risk-weighted assets in capital. In plain English, lend 100, keep 8 of your own. Sounds safe enough, right? But here's where it gets tricky. Government bonds got a 0% risk weight. That meant banks didn't need to keep any buffer when lending to governments. So what does that actually mean? It means the safest borrower on earth became the state itself, and money started flowing toward public debt instead of small business. A rule meant to make banks cautious ended up steering global credit into government hands. The regulators wanted safety. They got distortion. Footnote. Basel I standardized global banking risk but unintentionally incentivized massive lending to governments. 3. Basel II, when the fox wrote the rules. By 2004, banks had grown clever. They told regulators, we can measure risk ourselves now. The committee nodded and called it Basel II. It introduced 3 pillars: capital requirements, supervision, and market discipline. Sounds impressive, doesn't it? But in reality, banks got to use their own internal models to decide how safe their assets were. The safer they claimed something was, the less capital they had to keep. You can guess how that ended. So what does that actually mean? It means the fox got promoted to henhouse architect. When the 2008 crisis hit, the models collapsed faster than confidence. The safest assets turned out to be loaded with subprime mortgages. Basel II didn't reduce risk, it disguised it. Footnote. Basel II gave banks freedom to define risk, leading directly to the mispricing that fueled the 2008 global financial crisis. 4. Basel III, the cleanup crew. After the crash, regulators came back to Basel like firefighters revisiting the same burning building. Basel III arrived with stronger walls, new capital definitions, leverage ratios, liquidity coverage tests. On paper, it looked ironclad. But here's the twist: complexity replaced simplicity. What began as one clean rule became a spreadsheet maze of ratios, formulas, and acronyms. Even experts got lost. So what does that actually mean? It means Basel made finance safer on paper and stranger in practice. The world's banks still balance on thin equity. For every 100 in assets, some hold just 5 in real capital. Basel III promised transparency. It delivered opacity with better branding. Footnote. Basel III attempted reform through complexity, leaving the system technically safer but practically opaque. 5. Basel IV, safety by algorithm. When Basel III failed to stop banks from gaming the models, the committee tried again. Basel IV added an output floor, limiting how much a bank's creativity could shrink its capital requirement. A ceiling on cleverness, if you will. The idea was noble. The execution? More spreadsheets. It's simplified by adding another layer of complexity, an irony only a regulator could love. So what does that actually mean? It means Basel turned from safety code to performance art. Wealthy countries implemented it first, while developing ones struggled to keep up. The world split into financial classes, those who could afford compliance, and those who couldn't. Basel had become the price of admission to global finance. Footnote: Basel IV capped banks' model manipulation but deepened inequality between rich and developing nations. 6. The Hidden Empire. Basel has no police, no army, no flag. Yet every major economy follows its rules. Why? Reputation. Banks outside Basel's framework look reckless. Investors avoid them. Loans get pricier. The system enforces obedience without force. It's the perfect form of power, voluntary submission through fear of exclusion. So what does that actually mean? It means the invisible empire runs on trust and self-preservation, not law. Basel began as a meeting. It became a constitution. Every ratio, every acronym, Set 1, LCR, NSFR, isn't just policy, it's control written in math. And whoever writes the math, rules the money. Footnote: Basel's influence rests on reputation and dependency, turning voluntary guidelines into an unwritten global constitution for finance.